MEDP. So that's MedPace Holdings. And these guys provide clinical research-based drug and medical device development services in North America, Europe, and Asia. The company offers a suite of services supporting the clinical development process from phase 1 to phase 4 in various therapeutic areas. So they do the services to help a drug company go through the whole process of getting a potential drug through the steps and make it commercially viable. So that's what they do. That's interesting. 5-year, wow, this has been a great stock. It's up to 10.5 billion. It's really rewarded investors over the 5-year, 301% up. That looks really good. For the past year, it's pretty flat, 8.73. So it had a phenomenal 5-year. Things are slowing down for it. Curious to see over the 1 month, not much, and then the 1 year, 8.73. The company has revenue of 2 billion, PE ratio of 29 in the current year, and then the forward year will be 27.68. Analysts think it's a buy. It's discounted by 14.73%. Let's take a look at growth. So I like to see revenue growth. Revenue growth tells me that the company has good products that are in demand, so much so that they're getting more customers. Customers are buying more products from the things they offer. And it looks like there's green on the screen. It looks very, very good. Looking at the quarterly, the revenue continues, although it's slowed down a little bit in Q3, slowing down to 8.29, but still it is green. I like growth. Not bad at all. It is slowing down a bit, so maybe that's causing the 1-year performance not to be great if the sales are beginning to slow down a bit. Having said that, let's take a look at the gross profit and free cash flow. Most valuable companies have high gross margins, high free cash flow, and these guys have a nice gross margin level. 67% is very good. Very good gross margin. And the free cash flow, it's good that they've grown it. I always like seeing that there's growth over time on free cash flows. So this is a growing company, and I would value them at around 10 billion, maybe 15 billion, 10 to 15 billion based on free cash flows. And that's going to depend on the balance sheet, how much cash and debt they have. So the debt is very little, cash much higher. So they have a very strong balance sheet where they have plenty of cash to pay off all the debt that's on the balance sheet. This is a strong business, strong stock. They are fairly priced. Now you can argue that, hey, it's discounted because they're going to grow. And I would agree with you, but I would say that they're worth 10 billion, very conservatively, 15 billion if they're going to continue to grow quickly. How do I get there? I get there by taking their free cash flow. And since it's a growing company, I would multiply times 20. And their free cash flow is 535. If I multiply that times 20, I get to roughly $10.7 billion. And if I multiplied time, let's say 25 or so, then I get to a higher valuation. But that's what's getting me to that 10 to 15 billion in valuation for this company. This is a good business. One thing that's been occurring in the healthcare space is healthcare has had a tough year. You can see that in previous years, these guys were just doing really well. Stock was really moving upward, but now it's been trading somewhat flat, 8.73. That's not bad, but this is an interesting stock, not a bad stock at all. They're in a good space. They offer services in a area that's going to be consistently in demand. The development of drugs would just continue to exist. It's not going away anytime soon. So that is MedPace, really nice company. Thanks for bringing it up.